Fuel your investment returns via energy trade with LIOC. If you're a seasoned stock market investor, you are well aware that any type of event affecting the stock market has the ability to generate big winners and losers. One such event is the ongoing Iran war and the energy supply shock it triggered as a result of the Iranians blocking the Strait of Hormuz, which carries 1/5 of the global energy supply, cutting off fuel to Asia, Europe, and Africa. This has caused the global oil prices in the Brent Futures Exchange, that is the global benchmark for oil, to rise over 50% since the start of the war, and 80% from the beginning of this year. While the broader markets have come down quite sharply, one sector stood out, and that is the energy sector. For instance, in the US, the energy sector outperformed all sectors, giving a huge return of around 38% so far this year. Here in Sri Lanka too, we have a sole energy sector representation, and that is Lanka LIOC PLC. This is why we see the company's share to have some good upside in the near term from the current elevated fuel prices. In other words, we see Lanka LIOC to be a winner at present, although the rest of the market has taken some beating. We estimate the Lanka LIOC fair value at 186.4, which provides you with a solid 33% upside from where it's trading, currently at around 140. So let's look at why we think the company to do better in the current climate to help you to generate higher returns in the upcoming period. The first and the most key factor is the higher fuel price, which will result in higher top and bottom line for the company under the current fuel pricing formula. As you are aware, Sri Lanka since 2022 has been operating under what is referred to as a cost-reflective fuel pricing formula. Under this formula, the fuel price has risen around 35% since the beginning of the war, in late February to around the levels seen at the peak levels in 2022, when Sri Lanka was going through the deepest economic crisis. This will substantially increase the company's financial performance. However, we must remember that the company may not be able to sell fuel at the level before the war, as the government was forced to reintroduce the quota system to manage with the limited oil supplies. Hence, the higher revenues may somewhat be contained by the relatively low volume sales at the pump. Secondly, LIOC also has the ability to cash in from its existing stocks. The higher fuel prices, which would also help the company to cash in from its existing stocks which the company bought when the prices were relatively low, resulting in a windfall gain. For instance, by the end of December 2025, LIOC had around 26 billion worth of fuel inventory bought before the current spike in oil prices. Thirdly, LIOC is sitting on a massive cash pile which generates substantial pre-tax profit. LIOC is a unique company which generates around half of its pre-tax profits from the investment income which has been made possible from its investment portfolios. For the quarter ended in December 2025, the company generated 1.41 billion in finance income, which was roughly around 52% of the company's pre-tax profits. By then, the company had a massive 62.06 billion worth of investments in both long-term and short-term investments, including cash by the end of December 2025. Fourth and final, all of the above led to the company's ability to continue to pay dividends. For instance, the company paid 5 rupee per share in dividends in the financial year March 2025, and we expect a similar or even a better dividend for the foregoing financial year. With the dividend and the capital gain, your total return, which we also call the total shareholder return, could be higher than the 33% upside too. Hence, we believe LIOC to offer you a better investment opportunity which will further fuel your returns in your investment portfolio despite the current outlook appearing somewhat dim. For more information about the stock market, make sure to follow Capital Trust Securities.